The United States banking system is a quite complex and involves several working parts, ensuring the stability of the economy. One of those key resources is the Federal Reserve System. What is the Federal Reserve System? The Federal Reserve System, per definition, is the U.S. federal banking system that is under the control of a central board of governors, with a central bank in each of the 12 districts, and it has a wide power in controlling credit and the flow of money, as well as performing other functions, as regulating and supervising its member banks. During the 19th century and the beginning of the 20th century, financial panics plagued the United States, leading to bank failures and business bankruptcies that severely disrupted the economy. The failure of the nation's banking system to effectively provide funding to troubled depository institutions contributed significantly to the economy's vulnerability to financial panics. Short-term credit is an important source of liquidity when a bank experiences unexpected and widespread withdrawals during a financial panic. Banks during this period experience what is known as a bank run, which is when most of the bank's depositors withdraw their money and the bank does not have the cash to meet their deposits. After several banking panics, Congress passed the Federal Reserve Act to provide in the establishment of the Federal Reserve Bank and to furnish an elastic security currency for means of rediscounting commercial paper. To establish a more effective supervision of the banking in the United States and for purposes. President Woodrow Wilson signed the act into law on December 23, 1913. Originally, the Federal Reserve was instituted to provide lending during poor economic times, but over the years, Congress has broadened the role of the Federal Reserve through legislation. Today, the Federal Reserve's duties fall into four general areas: conducting the nation's monetary policy by influencing the monetary and credit conditions in the economy in pursuit of maximum employment, stable prices, and moderate long-term interest rates. Supervising and regulating banking institutions to ensure the safety and soundness of the nation's banking and financial system, and to protect the credit rights of the consumers. Maintaining the stability of the financial market system and containing systematic risks that also may arise in financial markets. Providing financial services to depository institutions, the United States government, and foreign official institutions. Congress designed the structure of the Federal Reserve System to give it a broad perspective on the economy and on economic activity in all parts of the nation. It is a federal system composed of a central governmental agency, the Board of Governors in Washington, D.C., and 12 regional reserve banks. The board and the Federal Reserve share responsibility for supervising and regulating certain financial institutions and activities, providing banking services to depository institutions in the federal government, and for ensuring that consumers receive adequate information and fair treatment for their business with the banking system. A major component of the Federal Reserve System is the Federal Open Market Committee, or known as the FOMC, which is made up of the members of the Board of Governors, the president of the Federal Reserve Bank of New York, and the president of 4 of the other Federal Reserve banks, who serve on a rotating basis. The FOMC oversees open market operations, which is a main tool used by Federal Reserve to influence overall monetary and credit conditions. The Federal Reserve is oversaw by the Board of Governors of the Federal Reserve System. Like the Federal Reserve, the Board of Governors is a federal government agency. The board is composed of 7 members who are appointed by the President of the United States and confirmed by the U.S. Senate. The full term of a board member is 14 years, and the appointments are staggered so that one term expires on January 31st of each even-numbered year. After serving a full term, the board members may not be reappointed. If a member leaves before the term's up, however, a person admitted to serve out the term may be appointed for a full term. The chairman and the vice president or vice chairman of the board are also appointed by the president and confirmed by the Senate. The nominees to these posts must already be board members or must be simultaneously appointed to the board. The terms for these positions are 4 years. The Board of Governors is supported by staff in Washington, D.C., numbering about 1,800 as of 2004. The Board of Responsibilities require thorough analysis of domestic and international financial and economic development. The Board carries out those responsibilities in conjunction with other components of the Federal Reserve Board. The Board of Governors also supervises and regulates the operations of the Federal Reserve Bank, exercises broad responsibilities in the nation's payment system, and administrates most of the nation's laws regarding consumer protection. Policy regarding open market registration is established by the FOMC. However, the Board of Governors has sole authority over changes in reserve requirements and must be approved any change in the discount rate initiated by the Federal Reserve Bank. The Federal Reserve is led by a chairman of the Board of Governors of the Federal Reserve System. The chairman is at the very top of the Federal Reserve System. The chairman directs monetary policy and determines the course that the Federal Reserve take. When the chairman speaks, business leaders, political leaders, and other people in the public take notice. The chairman is appointed to a 4-year term by the president, subject to confirmation by the Senate. However, unlike other presidential nominees, like the Secretary of State and Secretary of Defense, the Fed chairman is selected much more for the effective stewardship of the economy as for political philosophy. When the Federal Reserve System was created in 1913, the chairman had little power, but due to the Great Depression in the 1930s, the chairman is now one of the most powerful economic positions in the United States, and some say even in the world. The chairman generally sets the course of monetary policy and banking regulations. The wishes and policies of the chairman need not to be approved by the rest of the board, but are typically are. In addition to being the administrative head of the entire Federal Reserve System, the chairman also is head of the FOMC. The FOMC, which is charged with open market operations, is its primary vehicle for monetary policy. As of October 9th, 2013, Yellen was officially replaced Bernanke as head of the Federal Reserve System. A major component of the Federal Reserve System is the FOMC, which is made up of the Board of Governors, the President, Federal Reserve President of New York, the President of 4 other Federal Reserve banks who serve on a rotating basis. The Federal Reserve implements monetary policy through its control over the federal fund rate, which is the rate at which depositories, institutions trade balances at the Federal Reserve. It also influences the demand and the supply of these balances through 4 powerful tools. Open market operations, which is basically the purchase or sales of securities like U.S. Treasury bonds in the open market to influence the level of balances that depository institutions hold at the Federal Reserve banks. Federal Reserve requirements regarding the percentage of certain deposits that depository institutions must hold in reserve in forms of cash on account at the Federal Reserve. Contractual clearing balances are an amount that the depository institution agreed to hold at the Federal Reserve Bank in addition to any required reserve balance. And discount lending, which is an extension of credit to depository institutions made through their primary, second, and seasonal lending programs. The FOMC sets the federal fund rate at levels it believes will foster financial and monetary conditions consistent to achieving its monetary policies and objectives. And it adjusts the target in line with evolving economic development. A change in the federal fund rate or even a change in expectations about the future level of the fund rate can set off a chain of events that will affect the short-term interest rates, longer-term interest rates, and foreign exchange value of the dollar, and stock prices. In turn, changes in these variables will affect households and business spending decisions, thereby affecting growth and aggregate demand in the economy. Short-term interest rates, such as those of the Treasury bills and commercial paper, are affected not only by the current level of the federal fund rate, but also by the expectations about the overnight federal fund rate over the duration of the short-term contracts. As a result, short-term interest rates could decline if the Federal Reserve surprised market participants with a reduction in the federal fund rate, or if unfolding events was holding the federal fund rate lower than is to be anticipated. Similarly, short-term interest rates would increase if the federal fund surprised market participants by announcing an increase in the federal fund rate, or if some event prompted market participants to believe that the Federal Reserve was going to be holding the federal fund rate at a higher level than to be anticipated. The Federal Reserve System is a pivotal component of our economy. Without the monetary functions of the Federal Reserve, the economy in a downturn would be helpless without the guidance of the board and the chairman of the Board of Governors, overseeing critical financial instruments like credit and interest rates.